So, what's a company really worth? I'm not talking about its stock price, but its true fundamental value. Well, today we're going to become financial architects. We're going to draft the blueprint to uncover that hidden value using one of the most powerful tools in finance, the discounted cash flow analysis, or DCF.
All right, let's just jump right in with a huge question. We see stock prices flying up and down every single day. But is that number blinking on your screen the company's real intrinsic worth? The short answer? Not always. The thing is, the market can be, well, a little irrational. It's full of noise and emotion. To find the true signal, we need a much better tool.
So how do we find that signal? Well, let's try an analogy. Forget the chaos of the stock market for a second, and imagine you're a smart real estate investor. You're looking at an apartment building. You wouldn't just base your offer on what the building next door sold for, would you? Of course not. You'd ask a way smarter question. How much rental income, how much cold, hard cash is this building going to put in my pocket over the years? And guess what? A company is exactly the same. Its real value comes from the future cash it can generate.
Okay, so here's our game plan, our blueprint for today. We'll start with what value really is. Then we'll get into forecasting cash, figuring out the long-term picture, accounting for risk, putting all the pieces together, and finally, stress testing our work. All right, let's jump in. All right, first things first. Let's talk about our foundation. What is intrinsic value? Simply put, it's what a business is actually worth, deep down, based on its ability to generate cash. It has absolutely nothing to do with market hype or the daily mood swings of investors. Here it is, our 6-step master plan. Think of this like the ultimate recipe for finding value. We're going to forecast our main ingredient, cash. Then we'll estimate the long-term value and discount all of that back to what it's worth today. After a few important adjustments, boom, we'll get to our per-share value. Let's dig into each step. Okay, step 1. We need our raw materials. And in valuation, that raw material is free cash flow. This is the lifeblood of any company. It's not some fuzzy accounting profit. It's the actual cash left in the bank after paying for everything needed to run and grow the business. This is the good stuff that can be paid out to investors. Now, to be specific, we're talking about something called free cash flow to the firm, or FCFF. The whole point here is to see how much cash the core business operations churn out before we worry about how the company is financed. This gives us a really pure look at its operational engine. It's like looking at the total cash pie before it gets sliced up between lenders and owners. And this brings us to a golden rule in valuation you just can't break, the consistency principle. It's really simple. You have to match your cash flow to your discount rate. It's got to be apples to apples. If you're using FCFF, the cash available to the whole firm, you have to use a discount rate that reflects the risk for the whole firm, which is the WACC. If you mix and match, your entire valuation just falls apart. Okay, so we can probably make a decent guess about a company's cash flows for the next 5 years, maybe 10 if we're feeling bold, but then what? A healthy company doesn't just fall off a cliff in year 11. So how do we capture all the value it's going to create for the rest of its life? Well, that's where this huge concept called terminal value comes in. And you might think this is just some little calculation at the end, but no way. You cannot underestimate how important this is. Just look at this breakdown. In a lot of DCFs, the terminal value, all that value from year 11 into forever, can make up 75% or even more of the company's total worth. It's huge, which means the assumptions we make about the long-term future are absolutely everything. So how on earth do we calculate a number that big? Well, the most common way is a perpetuity growth model, and it's built on one massive assumption, that after our forecast period, the company will mature into a steady state, and its cash flows will grow at a slow, stable rate forever. Now, forever is, a pretty long time, so we can't get crazy here. Our assumptions have to be rock solid. The most important one is that growth rate, G. It has to be something sustainable, like 2 to 4%. Why? Well, think about it. If you assume a company will grow faster than the entire economy forever, you're mathematically saying that eventually that one company will become the world economy, which is, obviously not going to happen. Okay, so we've got all this future cash mapped out. Awesome. But there's a catch, right? $1 in 10 years is not worth the same as $1 in your hand today. We have to account for the time value of money, and we have to account for how risky those future cash flows are. That's the job of our discount rate, the WACC. It's our official reality check. WACC. It stands for Weighted Average Cost of Capital. It sounds really intimidating, I know, but the idea is actually pretty straightforward. Just think of it as the minimum return a company has to earn on its investments just to keep everybody who gave it money happy, both the lenders and the stockholders. It's the performance bar they have to clear. It's the hurdle rate.
And that weighted average part is key. As you can see here, if a company is funded mostly with money from shareholders, let's say 80%, then the return that they demand is going to be the main driver of the WACC. The cost of debt still matters, of course, but it just carries less weight in the final blend.
Now, the trickiest piece of this WAC puzzle is usually figuring out the cost of equity. For that, we use a classic model called the Capital Asset Pricing Model, or KPM. And it's really logical. You start with a baseline, the return you'd get on a totally safe investment like a government bond. Then you add an extra chunk of return to compensate for market risk, and you scale that chunk up or down based on how volatile this specific stock is. That scaling factor is called beta.
All right, this is the moment we've been waiting for. We have all of our pieces. We've got our projected cash flows, we've got our discount rate, the WACCs, to bring them all back to today's value. It's time to assemble our blueprint and see what this company is really worth.
Now pay close attention because this step is super important. When we discount all our cash flows, the number we get is the enterprise value. That's the value of the entire business operation. But if you're a stockholder, you don't own the whole operation. You own the equity. So we have to build a bridge to get from one to the other. We start with that total enterprise value, we add back any extra assets like excess cash, and then, and this is critical, we subtract anyone who has a claim that gets paid before shareholders, mainly debt. What's left over? That's the equity value. That's your slice of the pie.
So we did all that work, we have a number. We're done, right? No, not even close. A DCF is built on a mountain of assumptions about the future. And since none of us has a crystal ball, just presenting one single number is honestly dangerous and misleading. We have to stress test our work.
I love this quote because it just says it all. A single point valuation is financially indefensible. And why is that? Because our most important assumptions, that long-term growth rate G and our WACC, are just educated guesses. If you change either one by just a fraction of a percent, it can have a massive impact on your final answer. And this is the real payoff of a DCF. It's not one number. It's a range of possibilities shown in a sensitivity table like this one. Look here. At a 7% WACC and 2.5% growth, we get a value of $10.5 billion. But if we just nudge our risk assumption up 0.5% to a 7.5% WACC, the value drops by a full $1 billion. This isn't about finding the one right answer. It's about understanding what drives the value.
So let's boil this all down. If you remember just 3 things today, make it these. Number 1, DCF is all about finding a company's intrinsic value based on its ability to generate cash, period. It tunes out the market noise. 2, the valuation is super sensitive, and the terminal value, driven by your growth rate and WAC, is the most critical part. And 3, the final credible output of a DCF is always a valuation range, never one magic number. And for all you MBA students prepping for interviews in consulting or finance, you can bet this is coming up. Be ready to walk someone through these steps from top to bottom. Be able to explain exactly why we start with unlevered free cash flow. And most importantly, know how to talk about using sensitivity analysis to really test the key drivers of your model.
So, we've just handed you the blueprint for value. The final and maybe most important question is now yours to answer. Armed with this powerful tool, how would you compare your calculated valuation range to a company's current stock price and decide if you found a hidden bargain or if you're staring at a dangerous bubble?